And we're back, and it's time for Ask Annex. As always, got a question for us, you head to our website, annexwealth.com. Look for the Ask tab. We get back to everybody. Some wind up on the radio. In the studio, Matt Morzy, Director of Research, also a CFP at Annex. Welcome.
Hey, Danny.
Fred Coleman's a Branch Director, CFP, and a Wealth Manager at Annex Wealth Management. Good to see you.
Thank you, Danny.
Question 1 on Ask Annex. I realize markets can be bumpy, but I'd like to avoid it during the first part of my retirement. How is that accomplished?
That's a great question. And the thing about this one is it doesn't start at retirement. This is something that starts a little bit before retirement. So I would say 5 to 10 years before retirement, you want to start thinking about your cash flow strategy. You know, what are you going to do when it comes to retirement? Because you have to start preparing your portfolio. You know, when we talk about the accumulation stage, the goal is to really just grow your assets, build as much as possible. But when we start talking about retirement, it changes to that decumulation stage, and that's not necessarily an easy transition. So you want to start thinking about, hey, what money am I going to need short term? And that money should not necessarily be tied into the stock market or even the bond market. You wanted to have it in something that's a little bit more fixed. So, you know, when we do inevitably have those 10, 20% drops that come out through time, you're going to have a lot of those in retirement that doesn't affect your overall financial picture. If you look at, you know, the first 6 to 9 months in 2022, for a lot of people, that affected them because they didn't have the proper cash flow strategy. So a big part of retirement is not only what you do once you get to retirement, but leading up to retirement. And that cash flow strategy is a huge part of that.
Yeah, I think what's really important within all of that is to think long term. You know, a lot of times people have the thought process of when they think about how long they need their money to last or what their time horizon for investing is, they think it's to retirement, not through retirement. And so those first few years is just one small part of that. For many people are retired 10, 20, 30 plus years. And those first 5 years seem really important. And you certainly don't want a massive drawdown into that part because that can affect your long-term plan. Now, when you think of just looking at the U.S. stock market by the S&P, you know, and you're thinking, okay, what is the probability that this is going to be up over a certain time period? When you're looking at a 1 year time period historically, and I'm going back to 1950 with these numbers, the S&P is up 79% of the time over a 1 year time period. When you look at 3 years, it's up 90% of the time. And at 5 years, it's up 93% of the time. So if you structure, as you were talking through about that, Fred, your portfolio, and you're looking at what cash you're going to need in that early part of retirement, you really want to make sure that you don't necessarily have to pull from those investments during that time period. And if you have cash in the bank, you've got savings there, you have short-term fixed income, even longer-term fixed income to help buffer that so that you don't have to or are forced to take out of the stock market during that time period, you have a much longer time horizon than you probably think you do, and you're going to be able to weather those things without a problem.
That's the way we look at things. That's the way we plan for things. It's Ask Annex question 2. When you manage money, does that include shorting stocks?
Yeah, that's a great question. And frankly, we don't here. And just kind of a background on what shorting stocks is typically people are buying a stock hoping that it goes up, you know, or planning that it goes up. And what shorting stocks is going to be the opposite. Instead of buying something with cash that you have right now, you're now going to borrow in order shares of stock that you don't own and sell them, hoping that it goes down. And so you're going to profit if stocks go downwards, which is the opposite of everything that we ever think about from an investing point of view. And one thing to think about with that too is the level of risk that you're taking. Because let's say you bought a stock at $50. The worst thing that could happen is that stock goes down to zero, right? But when you short a stock at 50, there is no maximum upside for a stock. There's no cap on what a share price can be or what a company could be worth. So stocks can keep going up, and you're losing every time that company goes up. Now, brokerage firms have things in place. There's federal regulations on that so that if a stock keeps going up too much, you might have to be forced to either buy it back and get out or putting more and more money into the account in order to make sure that the levels are right on that. But the risk with shorting a stock is far greater than the risk on buying a stock is. And that's the reason why we don't do it. There's a lot of rules and regulations around that as well, too. And even thinking over the market over the last couple of years, there's a lot of really large companies. So that's what they did was short stocks or a part of what they did. Some of them have gone under. A lot of people have walked away from that. And if you think to that meme stock time period with GameStop and AMC, those retail investors were targeting short sellers and forcing them to get out of the market or to buy those shares back. And that actually drove those prices up even higher. And it could be, quite the thing if that happens.
It's Ask Annex question 3. Ooh, this question is for Fred. How often do recent retirees report difficulty adjusting to retirement?
Yeah, it's a great question because it is a real thing. I was reading an article and they said 1 in 8 retirees planned on going back to work in 2024. And I think that's a direct reflection of, hey, something didn't work out. Not necessarily financially. Financial is one part. We can help prepare you for that. But the emotional side is also very important. And that's the part that you have to really focus on, is being prepared mentally, because it's something totally different from what you're used to. A key things to focus on. You want to establish your identity beyond work. You want to visualize your retirement. These are all things that we're doing inside of the financial planning process. Not only are we making sure the numbers work, make sure the cash flow work, making sure the investments work, but also thinking about what's going to be the lifestyle. Are you going to travel? What are your hobbies? What is your desired level of activity? And then also making sure that you have realistic expectations, because there is going to be an adjustment period at the beginning of retirement. When you jump in, a lot of people, you retire right away. It's just it could be the honeymoon phase, 6 months to a year. You're not tired anymore. Now what do? That's when it really starts, and that's something we help with.
What was that phrase used earlier? Decumulation?
Decumulation.
That's going to be hard for me. I like the accumulation. That's Fred Coleman, a branch director, wealth manager, and a CFP at Annex. Thank you.
Thanks, Danny.
Matt Morzy, director of research, also a CFP. Thanks.
Thank you.